My definition of any smart investor is not buying a great business. So one of my earliest learning when I started managing fund, a great business or a company which is run by the best of the promoter does not necessarily mean a great investment. Even a mediocre company at the right price is a great investment, right?
Welcome to this episode of MF Bharat, Learn from the Masters. Today, we have Mr. Aishwarya Dadheech. Aishwarya is the founder and Chief Investment Officer of Fident Asset Management with nearly 2 decades of experience in equity management and research. He brings a deep commitment to disciplined investing and long-term value creation. Prior to founding Fident, he led the PMS strategies at Ambareesh Asset Management and previously managed equity portfolios at Reliance Life Insurance, where he consistently delivered industry-leading returns. He began his career at CRISIL as an equity and credit research analyst. Aishwarya is a chartered accountant and a CFA charter holder and also holds an MBA in finance. He is an alumnus of St. Xavier's College, Kolkata. His approach is rooted in rigorous research, sound risk management, and a steadfast focus on quality, making him a respected voice in India's investment management industry. Welcome, Aishwarya, and thanks for your time.
Thank you.
My first question would be on behalf of all those research analysts whose goal is to become a fund manager. Now, you also started as a research analyst, then moved on to fund management and EMS, basically. I mean, how has been your journey and what have been your learnings?
Yeah, so if I look back and ponder about my journey, I think I was very fortunate enough to start with an organization which I would say was a mecca of research in India, India's leading rating agency. And I had an opportunity to learn about various sectors in more depth.
Right.
And that gives me an edge to basically develop that relational ability of one sector's learning to implement into others. So to every research analyst who aspire to be a fund manager at some point of time in future, what is really important is to develop that relational ability. Because many of these analysts spend many years working on one or two sectors.
So it's very narrow, typically.
I would say that's required for you to get that grip.
Yeah.
But once you get the wider role, your ability to understand different sectors is tested. And that is very, very crucial when you run a fund, because you have to have a very holistic view or approach toward investment horizon. And that is, I think, is very, very crucial. So better it is if one start that learning early in the career. Otherwise, people find it very difficult who have spent many years just doing one sector to reach other sectors at one go.
So basically, they should try and keep moving sectors if possible, and maybe add more sectors to their.
Yeah, but that basically depends on their ecosystem and whether they have the ability to do that.
That's
what I used to do that when I got a couple of sectors, that much of my personal time I used to spend to understand more about other sectors which I was not officially doing. So that was a steal. I took some of my personal life to do that, but that eventually played and helped me in longer term. So I would just advise people to do that if they really want to become a fund manager.
So as a fund manager, tell me, is it harder to find a good business or it's harder to hold to cash in your portfolio? Because typically you normally have some cash in the portfolio. At times the cash amount goes up. So is it harder to find a good business to utilize that cash, or is it more difficult to hold cash because your investors will ask you for performance?
So I would say pragmatically it is very difficult to hold on to cash because market is so, I would say, tempting, if I may say so, that there will be opportunities every other day. And as you said, to get to the right business at the right price is very difficult, right? So normally people try to act, out of the whims to get into some business which they understand at that point of time. And then we realized that possibly we could have gone into some other businesses or better opportunities in investment. So I would say holding on to cash is much more difficult. And when the FOMO plays out,
yes,
it's not easy, trust me.
Hmm.
So I would say the later part is the difficult one.
Okay. And what's your view on the current valuations and the situation right now?
Situation right now is definitely tensed, right? We have been hit not only by FI, which has been sailing India, we all know about it aggressively. What is really important is to see that we have already gone through a very tough time in the last 18, 20 months, especially the broader market, right? There is hardly any return. Investors at all level, institutional or retail, has been struggling to make any money here or there. And on top of it, but I think that a lot of froth which has built up post 2021 till 23, 24.
Which got cleared to a certain extent.
Mostly got cleared.
Yeah.
Now, I won't say market is cheap, say, but market is definitely, I would say stock picker markets where you can now get opportunities which are fairly valued. What is really exciting which is happening is over the last 2-3 quarters, we are seeing earning momentum, which was missing over the last 2 years, is now building up gradually. So now if I see valuation in conjunction with growth, valuations are now making sense. To just put it in a very simple line, a lot of these businesses 2 years back, 1.5 years back, for a small cap and mid cap companies with a growth possibility of 20-25%, we're trading at 25 to 30 times PE forward. Now those valuation has gone to almost 15, 17, 18 times PE for the same kind of growth. So now market from that perspective is looking interesting.
Okay. Now, since you're finding valuations decent, I mean, what are those other parameters you look at? I mean, for example, the management or the moat. I mean, what is it that you look for? So,
if I just to summarize that answer, if I just summarize what my 20 years of learning has been about stock picking, I have 4 simple stages. I normally look out for good businesses. When I say good businesses, any business which has shown consistent return ratio in the past, 6, 7, 8 years of whether it is ROE or ROCE, depending on the nature of the business, and how whether they have seen improvement over that. So what I say is basically look for a good business. Now, those good business more has to be run by good people, people of high competence, integrity. That is very, very critical. And only these 2 will not suffice. We need good growth. Even if there's a great company, great management, if there's no growth, the probability of making money goes down low. And the 4th, which is the most important, that I want to buy these 3 important parameters, the good business, good management, and the good growth at a good valuation. So whether we will create alpha or whether we will create much better return than the market depend on the 4th important variable. So if you have to try to get this 4th thing in a bucket, and I can tell you it's not easy. So if you are able to do it correctly, you are bound to do lesser mistake and basically be on a wealth creation journey.
Okay. What is that one pattern in the market that you've seen which has not changed in your entire career?
I would say, if I see my learning and the stock which I have seen have created wealth or even which have not created wealth, I think stock prices rewards earning at the end of the day. You might be in different cycle, you might be in different era, ecosystem, but at the end of the day, stock prices will mirror the earning growth. There might be some themes that will work sometimes, some sectors will work sometimes.
There could be a delay, but
could be, there could be. We have seen in cases where there could be delay of 2-3 years. But if you have a 5, 7, 10-year view, and I think this is one exercise which every investors or even an analyst should do, that take a chart of the last 7 years, 10 years, earning trajectory of any company, and then look at the stock price movement. I can bet you there will not be much of a difference. 2-3% here or there.
That's fine.
Earning as CAGR at 15%, the stock most likely must have delivered at that kind of return long term. What investors should do to create alpha is whether you're able to buy those earnings during those tough valuation. That is where you can pick point and create alpha in that market. But this is one thesis which I think have played year after year, and just not in India. I think it has played out everywhere in the world.
Now, that brings me to another question, which is related to this. Since you said you need to buy during those rough periods, do you believe in timing the market to a certain extent?
I would.
Once you've decided that, okay, this is the stock I need to buy, would you look at timing it?
I believe in that camp that you should stay and give time to the market rather than timing it perfectly. Because see what happens if you are an individual investor, timing in and out become very, very difficult. Even the
Yes.
best of the brain globally has not been able to do that, right? So if I think we should make our life easier for investors, right? We professional can even think about getting into some businesses which we believe are attractive. But if you have got into a decent business at a right price, and if you think they have a long-term growth, let that money compound. That is what I understand. I will not advise individual investors to take that call of timing the market because
Right.
market is very volatile. Things can change overnight. See, today market, like crude is at $91 as we speak because
Yeah.
of this West Asia crisis. If I'm trying to time it, I'm trying to take a call on the macro. I'm trying to control the uncontrollables. And there are many variables which will play out.
Absolutely.
It's virtually impossible to do all of that. So sticks to earning and the cash flows and respect valuation. If you're doing that, I think your time in the market is more important.
Okay. This is as far as buying goes. Now, when it comes to exiting a stock, yes, I think one of the simplest thing is once your target is achieved, you exit. But then what is it that other than the target price do you consider when you have to exit a stock?
I would say exit strategy is 2 times more important than entry. Entry is relatively easier. And as you said, valuation obviously plays a very important role when you have to take that money off the table. But there are other variables which I think investors should also look at and which I personally very closely cater to when I do the investments. First is whether the investment thesis is playing out or not. There might be a case when you buy something with 3-year, 5-year view, and then you see that the investment thesis is sticking to what you thought, you stay put. But if you think the investment thesis is not playing out as you expected, introspect, cross-check. And that obviously a confirmation bias is always there, but then you have to make sure that you are not getting indulged by that. So if the investment thesis is not playing out, it's better to move out.
Right.
Third is if you find anything which doesn't fit on the corporate governance side, which develops post-trade investment. Anything, it could be, and it happens especially in mid and small cap side.
Yeah.
When you have entered, you think you cross-check everything, things look good, but then you start seeing things happening which is not in favor. Then it's difficult to get off, but it's better you get off that car which is going the other way around.
Yeah.
So I would believe these two are important.
Better to cut your losses. That's
Better
what
to
they
cut
say.
your loss.
Yeah.
That's I think very critical.
Okay. I believe that stock market is a place where you get opportunities on a daily basis. Then why do you think that there are so many investors who struggle to make money? I mean, what is it that they should avoid doing to ensure you get some decent returns on your investment?
So see, I believe the wealth is normally created by investors who have patience, right? On the other side, what we normally see is people get swayed by FOMO.
Right.
They get into something without understanding because others are doing that. Thing doesn't play out. They move out. Possibly, and majority of them doesn't even move out. They stay. They believe that okay, whatever price we got into it,
we'll get that price.
We'll get that price, and that mentally, I think I remember this line by Peter Lynch, which clearly says that it's cutting your profits early, and I would say
letting your losses run.
Losses goes. It's like you're cutting your flowers and you're watering the weed.
Yeah.
I think that beautifully summarized what the normal investor does, and that's why people don't really make money. I can tell you there is no investor, if you buy 10 stock, 10 will do well. Even 3 to 4 did well. You have to nurture that, which will take care of your overall portfolio.
Right.
But it's happened the other way around. People will sell if they go make up 30, 40, 50% return.
Yes.
And they will nurture their losses. The biggest money is made when the stock doubles. The biggest money is made post the stock doubles. And holding on to that thesis is very, very difficult. And that's where the wealth is created by people who have patience.
That's true. But unfortunately, I think a lot of people keep buying when it touches a 52-week low. They think that's the low and keep averaging. And every other day, you may see a 52-week low after that.
Yeah. So I believe the one thing which investor doesn't believe that equity, the lowest value is 0. So one thing is that is very, very critical, which people forget. But I think that you rightly summarize how people think through in short term.
That's true. And see, if you had to explain smart investing in one simple idea, what would it be?
So I would say smart investing is not about being following or all these narratives or themes. I think the best of the investors or the fund managers, the smart investing is all about what you are paying for that asset.
Uh-huh.
Everything boils down to valuation. If we don't have something on the table for us, for the cushion, that thing is very, very critical. So my definition of any smart investor is not buying a great business. So one of my earliest learning when I started managing fund was that a great business or a company which is run by the best of the promoter does not necessarily mean a great investment. Even a mediocre company at the right price is a great investment, right? So if you stick with that. So my thesis is very clear. If you have to be a smart investor, you have to know what you are paying for that assets. We do it in every aspect of our life, whether we go and do our shopping or whether we do our clothes, everything. We are very choosy about valuations, right? But in market, we don't do that.
That's true.
So that is, I think, is very, very important.
Because see, as an investor, you're not owning the company. You're not a business owner.
Yeah.
You're an investor. So there's a gap between that, because a number of businesses, the way I see it, is maybe good for the management, good for the business owner, but need not be good for an investor.
100%.
Yeah. A follow-up to this is in investing, what really matters more in the longer run? Intelligence or discipline? Or surely a bit of both.
Yeah.
Or what sort of percentage would you like?
So this is very close to me. I always believe that investing is not for rocket scientists.
Yeah.
It's not for engineers. Like you do need that kind of an intellectual like a doctor. I think it's a blend of EQ and IQ, where I believe EQ plays a bigger role. Trust me on this. Best of the investors who have created biggest of the wealth, if you look at their IQ score, I know they will not be at Einstein level. Trust me, and I'm open to say this.
Yeah.
It's more of an EQ which plays for their wealth to be created. So you obviously have to understand business. You have to understand what profits are, what
common sense.
It's very common sense.
Yeah.
You basically need class 6 mathematics to understand what you have to, or whether you are buying that business or not. But that EQ part, the behavioral part, how do you react to markets and things like that, and how do you manage your own finances? I think that is at least 3 times more important than IQ.
Okay.
That's what I believe in.
So you would say 25-75.
Oh, certainly, 75-25.
After working across research and fund management, in your opinion, what do people most misunderstand about equity investment?
At least my experience of meeting many individuals and all that, they all believe this is a casino, right? They believe this is a fancy place. Even a lot of youngsters whom I interview, they're all being crazy about investment management or investment banking and things like that. Actually, this is very boring. This is a place to create serious wealth. So the people really don't understand when they, even one of my learning when I started was that it's not about stock, it's about the business you're buying.
Yeah.
So, and I can tell you, out of 100 people, 95 people will not be able to run a business on its own. So what they can do, they can buy a business and create wealth that way. I think this part is misunderstood. Stock to them means like if I put some money, it will double, I will become rich, and it's like a casino. It's not.
Right.
That misconception has to be, this perception has to change. And that's why, which we have been witnessing over the last 5-7 years, the financial education saving is playing through. And that serious, mindset has to get inculcated by this new millennials and Gen Zs and things like that. I think this thing has to change. This understanding has to change.
And what is that one rule you personally follow that every investor you think should know and follow?
That if I put it into one rule, which I personally follow, I'm very sticky about the quality of the promoter. But it's become very difficult for an individual investor who is not having institutional setup to understand that. So I think, let me put it very simply, for everybody, I think one rule everybody should follow is not get into FOMO. That will save your bigger wealth. I have seen time and again we've been distracted by just having a herd mentality. You're just doing trades because others have told you without even thinking through.
Right.
And then you can't make money like that. So I think that is one thing which everybody should focus on. Buy something which, even if you understand some part of it, it should be your own decision. Then your ability to stay on that will increase. So you can't make money on borrowed conviction. That's if I may put it in a way.
Right. Because I think a very favorite phrase in this market is "अच्छा लगता है."
अच्छा लगता
I think most stocks are bought just based on
Just
this
because of
phrase. So just to follow up on this, I mean, if markets rewarded just one trait of an investor on a consistent basis, what would that trait be?
I think market rewards patience. Market rewards patience. I have seen cases, even in my own investment, which I've done, whether it was getting into persistent or into safari or into Laurel.
Basically, it should be a quality investment.
Yes.
But maybe at the wrong time.
Yes, you might have.
Yeah.
So there are many examples, where we have got into a stock and it didn't perform for some time, 1 year, 1.5 years.
Yeah.
But if you understand that the business is doing good, the promoters are trying to get the things in the right way.
Right.
And if you have that patience, which I believe is the most important trait, the probability of making meaningful wealth. A lot of people are excited about multi-baggers. Multi-baggers are not easy to get. They test your patience brutally.
Yeah.
Right. So that I believe is the biggest. And to talk to any investors who have really created big wealth, they have their own journey where their patience has been tested by this brutal market time and again. So I think that's one important.
Okay, I would like to ask you one more thing on multi-baggers. I think there's a myth that you can identify multi-baggers. And people at times ask me also, give me a stock which will become a 10-bagger. I mean, can you identify a 10-bagger? No.
Definitely not.
Yeah.
Anybody who have invested into stock which has gone 10, 20 or even 50 times.
Yes.
If they ask them truly that they would.
Did you know?
Answer is no.
Yes. You had a good story.
Yeah, you might have a great story.
Yes.
That every story is great.
Yes.
Which one will play out? And more than that, which one you carry with it when it's playing out.
Yeah.
If anybody has seen money going up 20 times or 30 times, it will take a long period of time.
Absolutely.
It doesn't happen in a jiffy.
Yeah.
And to stay that, you need that character.
Yeah.
So multi-baggers are not for everybody.
Yes.
You can double your money quickly with something here or there. But for multi-baggers, the serious wealth is created by multi-baggers. And as you said, that get to be cultivated over a period of time.
Yes.
So nobody knows. This is...
Yeah, because in multi-baggers, I think at every stage, you keep extending the target. Saying that, okay, it's performed like this, possibly in the next 6 months, 1 year, 2 years, we may get this sort of a performance. Yeah. Now, let me ask you some rapid fire questions.
Oh, wow.
I mean, what hurts performance more? Wrong stock picks or emotional decisions?
I would say it's more of emotional.
Emotion, yeah.
So it's definitely emotion. How do you react when market doesn't behave the way you expect it to behave? I think that creates bigger red mark.
And what do you think is a lesser evil? Fear or greed?
I have a different view here. I believe fear is the bigger evil because a lot of the people don't come to market because of this fear.
Yes.
And once you're not into the market, your probability of making money
it's
is
zero.
It's zero.
Yeah.
You're not making anything.
Yes.
So I would say greed is still better than fear here. So that I think that is something which is misunderstood.
No, I mean, I also believe in the same thing. Yeah. I mean, you need to be there in the market if you have to make any money.
Yes.
You may lose or whatever it is, but
you have to be there.
Yeah. Because fear does not allow you to get in the market. What's been your learnings from the biggest investing mistake you have done?
I would say, if I go through some of the mistakes which I did was on the ability to read the execution of the management. And sometimes you get swayed by that, the auras a lot of this management carry.
Yeah.
So I believe it's you should stick to have an indifferent view of whether things are playing out or not. If they're not playing out, at some point in time, we should take that call.
Okay. Now, as a research analyst or even as a fund manager, do you think it's very important to understand body language? Since you're talking about management.
100%. So I tell you one thing. I made a lot of management because that's our daily.
Yeah.
And I don't take whatever they say with a pinch of salt. I take it with a bag of salt. And whenever a management says lesser, I'm more interested with the body language. When they become very assertive in what they want to highlight, it's a red flag. It's just not here. It's in all part of our life.
Right.
So I think that also lives very beautifully here in this. And that's just not there when you meet them. How they talk on conference call, how they talk on media. All this gives you a lot of insights and,
that's true.
Ingredients to understand what.
Because I remember one incident when I met a promoter and he told me, I don't even know the price of my stock.
Yeah.
And suddenly his monitor shifted a bit and I could see the stock.
Okay.
And the website is open.
Yeah, so you can understand.
One unique quality about you as a fund manager?
I believe I am very optimistic. And I believe that is required for you to picturize or extrapolate the thought process about businesses, right? So if a company is making 100 crore of PAT day, and to envisage whether it can do 300 crore PAT in 5-7 years, you need big amount of optimism there, right? So to play that, I believe pessimistic are good to hear. They're intellectuals, right?
You can't be a fund manager as a pessimist.
You can't be a fund manager than pessimistic.
Yeah.
If you are pessimistic, then possibly this is not a profession for you.
Just what you talked about, fear and greed.
Yeah.
As a pessimist, end of the day, what is it? I mean, you are fearful.
Yes, you better be in debt. Or you're not even in debt. You keep your money in FDs.
Right.
So that is what it is.
One rule which you'll never break as far as the markets are concerned or investing is concerned.
I am very clear. I am not getting into FOMO for sure. There are many instances in my career where I've stayed away from one particular theme playing out and I was better off not getting into that. So that is very, very clear.
Okay. And what is the best investment advice you received till date?
The one which I said, I think the best investment advice is that don't get excited by the quality of the business or the promoter.
Right.
As I said, the great business is not a trophy you want to keep it in your Demat account.
Yeah.
Your Demat account should make money for you. So look out for businesses who have a better probability of making return for you. That is what I believe I've been staying with. And that has helped me in my career to create alpha over the last 20 years.
And could be repetitive, but one emotion investors must control.
I would say you need to control every emotions because market will behave the way market wants to behave, right? Whether it was COVID, whether it is West Asia and many such incidents, and it's also the other way around. There might be stock which are not running going up 30-40% in ZIF and things like that. So I believe the nerve of steel is very, very important, that you remain calm, composed, believe in your portfolio and not get swayed by what all happening around. So I think you have to control just not one emotions, all emotions which is emanating from your body.
Right. And maybe I'll just add one more thing. Maybe if you need to control all that, then possibly you need to also know what is in your portfolio.
Yes, 100%.
So 100%. At least you need to do some amount of basic research.
Yeah. And I want to tell every investor, don't think it's very complicated. Investing is very simple.
Absolutely.
You just need to put little brain to it and I think you will be sorted.
Yeah. And some hard work, which a lot of people don't want to put in.
But that's the way. Otherwise, give it to professionals. They will do better job.
And one myth about equity investing, which you'd like to bust today.
Equity investment is like one thing is that you don't think that you will become rich in a very short period of time. It's a painful, long process, but if you are part of it, market will reward you. So don't have too much of expectation in short terms. And I can tell you, a lot of people have a ability to exaggerate that thing in their portfolio. So there will be 10 stock, the 2 will do well. They will talk about 2 stock or a glass of wine. They will not talk about the remaining 8, right? So don't get swayed by what others are talking and doing. Everybody has their own way of life. So don't think that equity will make me rich in short term. This is very, very important. And a lot of people think it happens.
Right.
So it doesn't.
So thanks, Aishwarya. End of all the questions.
Thank you, sir. Thank you so much.
And thank you for your pearls of wisdom. And I'm quite sure it will help all the viewers. Thank you, viewers, for watching this episode. And do subscribe to MF Bharat for such interesting conversations going ahead.